The Learning Station. 2008 Financial Crisis explained. In 2008, the world faced one of the most significant financial crises in history, leading to the collapse of some of the world's largest financial institutions such as Lehman Brothers, AIG, and Bear Stearns, and caused severe economic consequences worldwide. So, what exactly happened? Crises began in 2007 with the collapse of the U.S. housing market and the subprime mortgage industry, and it culminated in the fall of major financial institutions in 2008. But to understand the 2008 financial crisis, we need to go back to the early 2000s when the U.S. government wanted to increase the rate of homeownership. To achieve this, they introduced policies that made it easier for people to get mortgages, even if they didn't have enough money to pay for them. Banks and financial institutions took advantage of these policies and started offering mortgages to almost anyone, regardless of their ability to pay them back. These loans were then bundled together and sold as securities to investors around the world. This created a housing bubble, where home prices were artificially inflated, leading to a false sense of security in the market. However, when people started defaulting on their loans, the housing bubble burst, causing home prices to plummet, and many investors to lose their money. This led to a chain reaction of events, with the collapse of Lehman Brothers, one of the world's largest investment banks, triggering a global financial crisis. The crisis led to a credit crunch, where banks stopped lending to each other, making it difficult for businesses and individuals to access credit. This, in turn, led to a severe economic downturn, with many people losing their jobs and homes. Here's a detailed timeline of the events that led up to and occurred during the 2008 financial crisis, from 2006 to 2008. 2006. The U.S. housing market begins to cool down, and home prices start to decline. Increasing numbers of homeowners begin to default on their subprime mortgages, given to borrowers with poor credit or limited income. The subprime mortgage crisis starts to emerge, as many of the riskiest mortgages begin to default at alarming rates. 2007. The U.S. housing market continues to decline, and home prices fall sharply. Many hedge funds that had invested heavily in subprime mortgages begin to fail. The subprime mortgage crisis spreads to other sectors of the financial industry. The interbank lending market seizes up as banks become increasingly wary of lending to one another. 2008. January. Citigroup reports massive losses and announces layoffs. March. Bear Stearns, a major investment bank, collapses due to heavy losses from subprime mortgages. The U.S. government facilitates its sale to J.P. Morgan Chase. July. IndyMac, a major mortgage lender, fails and is seized by regulators. September. The U.S. government takes over Fannie Mae and Freddie Mac, two government-sponsored mortgage lenders. Lehman Brothers, another major investment bank, files for bankruptcy, causing panic in financial markets worldwide. The U.S. government bails out American International Group, AIG, a major insurance company that had insured many subprime mortgage-backed. October. The U.S. government passes the Troubled Asset Relief Program, TARP, which authorizes $700 billion in funding to stabilize the financial system and prevent further collapses. October 6. The stock market experiences its largest point drop in history. October 7. U.S. Federal Reserve announces an emergency interest rate cut. October 8. Several major European banks, including Royal Bank of Scotland and Fortis, are bailed out by their respective governments. October 13. The U.S. government announces it will invest directly in major U.S. banks through the Capital Purchase Program. October 29. The U.S. stock market experiences its second-largest percent drop in history. November 4. Barack Obama is elected as the 44th President of the United States. November 17. The U.S. government announces a bailout plan for the U.S. auto industry. December 1. The National Bureau of Economic Research announces that the U.S. has been in a recession since December 2007. December 16, the U.S. Federal Reserve announces it will lower interest rates to near zero in an effort to stimulate the economy. Wealth destroyed by the financial institutions. The crisis also exposed flaws in the banking and financial system, leading to significant reforms and regulations to prevent a similar crisis from happening in the future. While the 2008 financial crisis was a challenging time for the world, it taught us valuable lessons and forced us to re-evaluate our financial systems to prevent such a disaster from happening again. This has been our brief overview of the 2008 financial crisis. Thanks for watching.